Listen up, investors. Shane here, want to pick winning stocks? You've got to understand valuation. It's like checking the price tag before you buy. Valuation methods help us figure out if a stock is a steal or a dud. They tell us if a company is worth the price it's trading at. Don't get scared off by fancy terms. We'll break it down for you. Think of it like this. You wouldn't buy an old used car for the price of a Ferrari, right? Same goes for stocks. Valuation helps us find those hidden gems. We're about to unlock the secrets of 3 powerful valuation methods: PE ratio, EV/EBITDA, and EV revenue. Get ready to make smarter investment decisions. First up is the PE ratio, or price to earnings ratio. This one's a classic, folks. It tells us how much investors are willing to pay for every dollar of a company's earnings. Here's the deal. A high PE ratio usually means investors are optimistic about the company's future growth. They're willing to pay a premium. On the flip side, a low PE ratio could mean the company is undervalued or seen as less risky. It's like getting a bargain. Let's say company A has a PE of 20. That means investors are paying $20 for every $1 of earnings. Company B has a PE of 10, meaning investors are paying $10 for every $1 of earnings. See the difference? The PE ratio helps us compare companies and see which one might be a better value. Now, let's talk EV/EBITDA. Sounds complicated, but it's not. EV stands for enterprise value, which is like the total cost of buying a company. EBITDA is earnings before interest, taxes, depreciation, and amortization. Think of it as a company's core operating cash flow. EV/EBITDA gives us a clearer picture of a company's financial health. It cuts through the noise of accounting tricks and focuses on actual cash flow. This ratio is especially useful for comparing companies with different debt levels or tax rates. It levels the playing field and helps us see which company is truly more profitable. Remember, a lower EV/EBITDA usually indicates a better value. It means you're getting more bang for your buck. Section 4, EV revenue, sizing up sales. Last but not least, we have the EV revenue ratio. This one's all about sales. It compares a company's enterprise value to its revenue, giving us an idea of how much we're paying for every dollar of sales. This ratio is particularly helpful for valuing companies that aren't yet profitable, like startups. They may not have earnings yet, but they're generating revenue. A lower EV revenue ratio generally suggests a better value. It means the company is generating more sales for its size, which is a good sign for future growth. Keep in mind, the EV revenue ratio should be used with other metrics to get a complete picture. Section 5, comparing apples to apples using ratios together. Here's the thing, folks, no single valuation method is perfect. They each have their strengths and weaknesses. That's why it's crucial to use them together. Think of these ratios as tools in your investment toolbox. By using them together, you can get a well-rounded view of a company's value. Compare companies within the same industry to see which ones stand out. Look for companies with strong earnings, healthy cash flow, and growing revenue. Remember, valuation is just one piece of the puzzle. It's also important to consider factors like management quality, industry trends, and overall market conditions. Section 6, conclusion valuation, your key to smart investing. There you have it, folks. We've demystified 3 powerful valuation methods: PE ratio, EV/EBITDA, and EV revenue. Armed with this knowledge, you're well on your way to becoming a smarter investor. Remember, valuation is not about predicting the future. It's about understanding a company's worth today. and making informed decisions based on that information. So do your homework, compare those companies, and invest with confidence. This video was brought to you by North Square Capital.